In this video, we're going to talk about the financial market environment itself. Exactly what is it we're going to be talking about? We're going to talk about some institutions that play important roles. We'll talk about financial marketplaces and some of the regulations, but we'll also talk a little bit about the process of issuing securities. So if you think about institutions, right, firms obviously require money from time to time from external sources. So how can they get them? They can either get them through financial institutions, they can get money from financial markets, they can get money from private placement, right? So the primary sources, let's think about the sources of long-term financing. Where does a company go to get money that they're not going to pay back for more than a year? Typically, we're talking about bonds and long-term types of loans. Talk about preferred stock. However, there isn't all that much preferred stock issued. Common stock, obviously, but also a source of financing that's not external but is internal are the profits of the company or retained earnings. The institutions we're talking about have a term that are referred to as intermediaries. Essentially, they stand between those folks that have more money than they need and those folks that need money to do things. So the key suppliers are typically individuals, net, and the key demanders are businesses and the government. So the suppliers are essentially you and I, net, right? Obviously, some of us don't invest a lot of money, but we do save money from time to time. So all of that could be incorporated then into the supply and demand mechanism for interest rates. The banking system itself, primarily what we're going to talk about are commercial banks. But commercial banks, obviously, that's where you and I go for our checking accounts, maybe some short-term savings accounts, etc. But we also have things referred to as investment banks. These are companies that assist corporations in raising funds, right? Most corporations don't have a department, if you will, that's there to take care of issuing stocks and bonds. We do this by outsourcing. But there is also something that's referred to as shadow banking. Shadow banking are when institutions, large institutions in general, basically engage in lending and borrowing, but they don't do it through these institutions don't do it through a traditional bank, if you will. They don't have the same kinds of regulations as traditional banks, but they typically are there to work with actually very large institutions themselves. So financial markets, again, are places, they're forums where suppliers of funds and the demanders of funds meet, right? The transactions can be short-term, they can be long-term. A private placement involves a sale directly to an investor or a group of investors, going around the idea of a financial intermediary. Now, the issue with this, it seems like, well, why wouldn't everybody do that? Number one is you have to find the people to invest. And number two is there are regulations in place that limit what you can do with the securities once you buy them. So there, it sounds like a really good deal, but there are some downfalls of trying to use private placements. Most companies use public offering, right? They sell their stocks and bonds, or issue them is the better phrase, to the general public. Now, if you want to think about how can we talk about markets, right? We can talk about them in different ways. We can classify markets by dollars, right? So the primary market, this is the financial market where securities are initially issued. It's the only market in which the issuer is involved. That is, it's the only place where the corporation, if you will, is actually going to get money. This obviously an IPO, or initial public offering, is part of that. Secondary markets are every time the securities trade after the first time. So this is, you and I are now trading securities, and corporations are not involved. There is a video, if you look through the notes, where you can go out and you can find some information out about IPOs. But again, it's a very short, it's about a 2-minute video, but it's a pretty good description of how initial public offerings work. We can also segment markets by time. The life expectancy of a market provides the mechanism for gathering funds for different purposes. Money markets are financial markets that are short-term. The definition of short-term in business is less than 1 year. So it's 1 year or less is a money market instrument. A capital market is for some type of financing that's greater than a year. So other markets talked about who gets the money. These markets just separate it by time. And I think this might make a little bit of sense. I mean, it's not like this definition is important as the other definition. But if you were buying a truckload of bananas, you probably wouldn't want to take out a 5-year loan on a truckload of bananas, right? The idea is you want to match life expectancy of assets with the type of financing that you gather. So money markets, again, it's created by this relationship. It's short-term funds. Most of these funds are what are referred to as marketable securities. The predominant kind of security is something called a treasury bill, United States Treasury bills. But we have commercial paper. We also have some negotiated CDs issued by financial institutions. But investors here are primarily interested in the least risky kinds of things they can invest in. It's short-term, very low risk. There are obviously even some short-term securities that are European or are international in nature. So obviously those would be typically lower risk, but however they have the international risk piece that gets incorporated in investing in that type of asset. Capital markets then are long-term transactions. The primary types of securities we're talking about here are stocks, bonds, preferred stock. Bonds are obviously long-term debt instruments. They raise lots of money by borrowing money. Common stock is where we issue units of ownership, right? It's equity in the corporation. Now, a preferred stock is a special form of ownership that it has features of both stocks and bonds. Now, preferred stock is not as prevalent as common stock and bonds, but they are available. They are out there. We just won't talk about them in any real great detail. Another way to talk about the different types of markets is really to look more at the selling mechanism, right? A broker market, these are exchanges, securities exchanges, where the two sides come together, right? They're brought together to trade securities. It happens at an exchange. It's a place like the New York Stock Exchange. There are regional exchanges. There are exchanges for options and bonds. These are actually places. A dealer market, though, the most commonly recognized one is something called NASDAQ. This is where buyers and sellers are not brought together directly, but indirectly through a computer network. So these securities dealers that are in this network are what we refer to as what they do is they make markets. So the dealer market has no place. It's a computerized network, right? As compensation, what these guys receive as compensation then is what's referred to as the bid-ask price. And we'll talk about these a little bit later in another video.